Hello friends, I welcome all of you once again for our second part of Ind AS 101 session. First part we have already discussed in our last session. I hope you enjoyed it and I think it made a value addition for your knowledge. So in this part basically we will discuss about two things. First things the about the exceptions which is related to retrospective applications of Ind AS. And then use of deemed cost. How many types, what are the fields, what are the area where the deemed cost is play a very important role. So we will discuss about this in detail. So let's start without wasting any time. So as I told you earlier that the today agenda is based on our two topics. One is deemed cost, second is exceptions from the retrospective application from other NDAs. So in first topic we will discuss about the 8 type of exceptions related to retrospective application for other NDAs. So let's start. Topic number 1, exception of the retrospective application. So there are 8 types. First is derecognition of financial assets and liabilities, then hedging accounting, estimates, assets held for sale and discontinued operation, and non-controlling interest, basically minority interest, then government loan and derivative, and impairment of financial assets. So each topic we will discuss from the next slide. Topic number 1.1, derecognition of financial assets and financial liabilities. So first of all, entity must apply the recognition requirement which is defined in Ind AS 109 prospectively for those transactions occurred on or after the date of transitions. Number 1. So what is the derecognition requirement procedure? First of all, there must be a contextual right under which entity is able to receive cash from the financial assets. Okay, then financial assets has been sold and risk and reward related to these transaction has been open. Okay, then derecognition, in case of derecognition of financial liabilities, this financial liability should be settled. Okay, when it is settled, when we pay these liabilities or we transfer these liabilities to some other third parties, or any gain or loss related to such financial liability is booked in the income statement. Once these 5 conditions is met, so we will qualify, the assets or liability will be qualified for the recognitions. Entity may apply the derecognition requirement retrospectively for those transactions which occurred in past, but we must have the informations which are available, and these transactions are used at the time we are booking these transactions initially. Okay, first time, when we first time book these transactions, what are the basis means whatever the information we have at that time, this information we should have. Okay, second thing, for product number 1, I just want to give you one example. Suppose we are going to suppose entity derecognize non-derivative financial assets or financial liabilities which is occurred in past based on the previous gap. Okay, so these transactions will not be recognized in the financial statement based on the Ind AS unless these transactions qualify for recognition criteria in a later date. Okay, so this is 1.1. Topic number 1.2, hedge accounting. So first of all, first time adopter has to measure all their derivatives at fair value at the date of transition as per the Ind AS 39. Okay, they have to ignore all the deferred losses and the gains which is from the derivatives as per the previous gap, as if they are considered as assets or liabilities. Then if there is any hedge relationship which does not meet the criteria of hedge accounting, these should be ignored. So what are those criteria? These criteria I have given below. First of all, there must be a proper documentation which define the hedge relationship. Then hedge accounting shall be accepted from that date where we have a documentation in a correct manner. The main purpose of the hedge accounting that it will highly capable to offset our losses, but for that the hedges is done by the entities. Hedge effectiveness must be reliably measured, and these hedges should be regularly assessed to check their performance whether we are able to offset our losses. Okay, and if there is any change in our cash flow due to these hedges, so we have also explained this. Okay, sometimes it's happen the entity do some transactions for hedges purpose, but these hedges does not qualify the criteria of hedge accounting as per the Ind AS 39. So in that case, for those transactions, first time adopters does not consider these transactions as a hedges retrospectively. So these things we have to keep in mind. Topic number 1.3, estimates exception. So first of all, in case of estimates, entity has to apply the Ind AS 8 and Ind AS 10 principles to measure and recognize the estimates. So Ind AS 8, which is related to accounting policies, change in accounting estimates and the errors, and Ind AS 10, event reporting after the balance sheet date. So they have to follow that principles. So if estimate made as per the Ind AS at the date of transition should be consistent with the estimate made under the previous gap on same date. So we have to keep in mind these things. If suppose sometimes it happen company receive any evidence on which the estimate is based, but this evidence is received by the company after the date of transition date. So in that case, company consider these type of estimates, this type of error as a non-adjusting events. Okay. Topic number 1.4, assets held for sale and discontinue operation. So here the Ind AS 105 shall be applied by the first time adopter prospectively to non-current assets, okay, that meet the criteria of assets held for sale as well as the criteria for discontinued operations after the effective date of Ind AS. One thing, so what are those criteria? There are the 5 criteria which I have given here. So carrying amount of non-current assets shall be recovered through the sales transaction. Sales transaction may be include the exchange of one non-current assets with the other non-current assets. This sale transaction must be completed within 1 year and the sale is highly probable. Okay, then the classification condition of held for sale shall be met at the balance sheet. So this is the 5 criteria to recognize any assets held for sale or discontinue operations. Okay, for Ind AS 105 also allow to the requirement of the Ind AS 10 form, which is related to the valuation and the measurement of the assets held for sale as well as the discontinued operation. It is applicable to all non-current assets. So this thing we have also keep in mind. Okay, so in this case there is only these 2 requirements. First, assets must be meet the criteria of assets held for sale and discontinued operation, which is defined under section 105, and rule of Ind AS 101 is also applicable in case of assets which is classified as a asset held for sale and a discontinued operation for valuation measurement purpose. Topic number 1.5, non-controlling interest. So first of all, first time adopter has to apply the principle of Ind AS 110, which is related to consolidate financial statement prospectively after that from the date of transitions to prepare the first time Ind AS financial statement. Then they have to divide the total comprehensive income between the owner of the parents and the non-controlling interest persons. They have to apply the principle of the Ind AS 105, which is assets held for sale and discontinue operation for the in that case where there is a loss of control over the subsidiaries. If suppose a company who is a first time adopter wants to follow the option of Ind AS 103 retrospectively in case of past business combinations, so they have to also follow the provision of Ind AS 110 consolidated financial statements. So these things we have to keep in mind while we are taking into consideration the exception related to non-controlling interest. Topic number 1.6, government loan. So here first of all, the first time adopter shall classify all the government loan received either as a financial liability or as a equity instrument, which is defined as per Ind AS 32. Then they have to follow all the rules and regulation which is defined in Ind AS 109 financial instrument and Ind AS 20, which is accounting for the government grant and the disclosure of the government assistance. Suppose entity does not recognize and measure the amount which is defined as per Ind AS. So in that case, the carrying amount calculated as per the previous gap shall be the carrying amount at the date of transition. Okay, then entity shall not recognize the benefits which is received from the government loan which is received below the market rate of interest will as a government grant. Fine. Last, not last, the entity will follow all the requirements which is explained or giving under 109 related to measurement of such loans after the date of transitions. Okay, this is one thing. Second thing is all the Ind AS 10, all the requirement of Ind AS 109 and Ind AS 20 shall be applied prospectively, not retrospectively. These things we have to keep in mind. So this is all about the government loans. Now come to the next point, which is last. Topic number 1.7, embedded derivatives and impairment of financial assets. So first of all, we discuss about the impairment of financial assets. So for impairment of financial assets, the first time adopter means entity first use the reasonable information to compare the credit risk between the date of initial recognition and the date of the transitions. So what are the reasonable information? So first of all, these should be these information may be external or internal. Like reasonable information is financial position of the borrower, capital adequacy of the borrower, payment track record of the borrower, civil report, okay, revenue generation capacity of the entity. So these things we have to keep in mind for the reasonable information. If suppose there is any significant change in the credit risk from the date of inception, so it will recognize the loss allowances which he made to the extent of the lifetime expected credit losses at each reporting date till the derecognition of the financial assets. So what are the derecognition of the financial assets conditions? We already discussed in the earlier slides. Then in the last we will do the review test at the we will do the review test for the credit risk by using the principle of Ind AS 109. Okay, these things. Now these four condition is very useful for Ind AS 101 adopters. Now embedded derivatives. Embedded derivatives are those is a hybrid contract which have a two characteristics. First, it is a host contract, and second is the derivatives. Just an example, you have taken loan from the bank where the interest rate is linked with the price of the commodity. If there is any change in the price of the commodity, so interest rate will be changed accordingly. So these things we have to keep in mind. For the derivative portions in embedded derivatives, so the derivative portions will be accounted at fair value in the on the balance sheet. If there any change in the fair value, so it should be recognized into the income statement. That is the derivative valuation prospect. Now for Ind AS 101 adopters, the entity must require to identify if there is any embedded derivatives, so it will accounted, such derivatives will be accounted separately from the host contract if following conditions are met. So what are those conditions? Embedded furniture meet the definition of derivatives. First of all, the embedded derivative must meet the derivatives. Second thing, any economic characteristic or risk of embedded feature are not closely related with the host contract. Means economic characteristic and the risk of the embedded is only related to the derivatives. Third point and very important point, combined contract means overall hybrid contract. Overall contract shall not be measured at the fair value. Also, if there is any change in the fair value, will not be recognized in the P&L account. If the combined contract is already accounted at a fair value, so there is no need to separate it. Okay, these things we have to keep in mind. So we already cleared first point, determine the embedded derivative shall be separate from the host contract, then recognize as a derivative based on the condition exist on the later date. So what are those conditions? We already explained you three conditions. There are three conditions. Okay, first of all, it is not closely linked with the host contract. Second, there is a meet the definition of derivatives, and third, if it is a combined contract, so the measure at the fair value is not measured at the fair value. Also, is there any change in the fair value will not be recognized with the financial statements. So this is our 1.7. Topic number 2, type of. Here we will discuss about how many types of deemed cost and their disclosures. So first of all, we have to understand what is the deemed cost. So deemed cost is a nothing, it is a representative amount which is used to calculate the depreciation and amortizations after a date of transitions. Okay, so basically these are the fair value at the date of transition, or maybe the carrying amount calculated as per the previous gap. Okay, in mostly cases. Now in the right hand side I have giving the how many types. So basically there are 5 types. Is use of deemed cost in case of property, plant and equipment, use of deemed cost for the investment in subsidiary, associate and joint ventures, use of deemed cost in oil and gas industries, and for use of deemed cost for operation subjected to rate regulated, then use of deemed cost after severe hyperinflation. So first of all, we'll discuss about the use of deemed cost in property, plant and equipment. So in case of property, plant and equipment, fair value at the date of transitions, okay, to prepare the opening balance sheet, or revaluation amount calculated as per the previous gap shall be our deemed cost. It is the choice of the entity what he choose. Then for investment property, they have to value their investment as per the cost model or fair value at the date of transition which is suitable from them. Intangible assets, either they may use the cost model which is defined under the Ind AS 38, or revaluation amount based on the previous gap they have to follow. So these things, it is up to a company what he is electing to consider as a deemed cost. 2.1 disclosure. 2.1 disclosure, deemed cost for other entities. Here the other entity means the subsidiaries, joint ventures and the associates. So here company has to disclose the aggregate amount of deemed cost, in which the deemed cost is a carrying amount calculated based on the previous gap for the investments made. Then if entity also has to disclose separately the aggregate amount of deemed cost for those investment for which the deemed cost is considered as a fair value of the investment at the date of transitions. Okay, third part, they have to disclose the adjustment they have made in the carrying amount as per the previous gap. Okay, so these things they have to disclose. So 3 things they have to disclose in case of investment in other entities. Topic number 2.2, here we will discuss, not in detail, but the deemed cost for oil and gas perspective, as well as the operations which are regulated through the regulations, which rates are regulated through the regulations. Okay, so for the treatment is same. Basically if we are considering deemed cost for oil and gases, so entity has to disclose the facts on which the carrying amount is calculated as per the previous gap, the deemed cost, and also they have to disclose the computation criteria, means calculation procedure they have followed to compute or calculate the carrying amount as per previous gap as a deemed cost. So same thing they have to perform in if entity deal in the operation which is rates is regulated to the government. So they have to disclose the facts about the carrying amount, and then they have also disclosed the procedure for computation of deemed such carrying amount which is used as a deemed cost. Topic number 2.3, disclosure, deemed cost after severe hyperinflation. So if company has elected that they will measure their assets and liability at fair value and use that fair value as a deemed cost, so they in their opening Ind AS balance sheet, but because of severe inflations they have to give the additional explanation. They have to explain why and how the function and entity had a functional currency for which general price index is not available for those transactions and balances which had occurred with the other entities. Okay, second thing, they have also explained and give the reason why and how about the functional currency, that the exchangeable relationship does not exist between the functional currency and the stable
foreign currency. So these things they have to give in addition. Okay. So this is all about the exceptions of the retrospective application from other indices as well as the use of redeem cost. I hope I tried to fulfill your requirements, and it also made a value addition in your knowledge, guys. So thank you so much to listening me. We will meet again to discuss part 3, which is the final part of Ind AS 101 very soon. Till then, good for now. Bye.